Hey everyone, this is Kirk here again at OptionAlpha.com and welcome back. You made it to week 3. Thank you so much for checking out this video tutorial. I commend you for continuing on with this course, and I know you are learning a ton about options, or you really wouldn't be here on video number 3. You would have kind of stopped with video 1 and 2, so I know you're committed. And in this week's video, I'm going to go even deeper into understanding risk and the business of options trading. And I know this is a hot topic, so that's what we're going to get into. But before we do that, let's recap what we talked about in video number 1 and video number 2 quickly. So video number 1, we talked about why options versus stocks, right? This is the whole premise, right? Why are we even considering options versus stocks? In video number 2, we talked about, okay, we understand that we're going to trade options, but what are the top options trading principles or options pricing principles? So that's what we covered in video number 2. Now right now in video number 3, we're going to talk about risk and the full-time aspect of trading as a business. And then in video 4, which will come out in a couple days, we're going to take a detailed look into the strategies that I use month after month to generate income. And we're going to go over some examples live with market pricing, at least live at the time that I'm going to record the video. All right, so let's get started. Remember, paper, pen, and notes. There's going to be a ton of information here. You can go back, watch this video a million times. It's all completely free. And oh yeah, I forgot one more thing. As always, if you have any questions or comments as I go through this, please add them below to the section. I will get to everyone's answer right away. All right, so let's talk about that big scary word, risk, right? And this is the thing that everyone is concerned about with options trading is what's the risk? It's risky. It's this, it's that. It has unlimited risk, limited risk. There's so much risk being thrown around that I think it can get confusing for new traders and even for experienced traders what the real risk is. Now, remember in video 2, we talked about the markets being random and trading based on probabilities, right? You remember that in video 2. And it's true, the market is 100% random. And with this distribution graph up here, this kind of emphasizes what we talk about is the fact that the market makes random movement, and those random movements can be plotted to probabilities and percentages over time, or standard deviations, if you ever learn anything about options trading as it relates to probabilities. So what we do here is we take that graph and we flip it sideways so it can visually show you what we're talking about. So again, just as a review, if this is the S&P or the SPY, then we have this probability graph that says, okay, the vast majority of the time, the S&P is going to close within this range in a given time period. And then as that time period expands, the probability that it gets to these further edges increases because we're giving the market more time. So again, the more trades we can place, the more the probabilities will work themselves out over time. Think about each one of these little dots here as a specific trade. So the more times you can place trades, the more times you're going to have probabilities work themselves out over time. And that's the name of the game. Well, here's the one question that I get asked a ton, and I also asked myself when I got started in options trading. If we're supposed to trade on probabilities, then factoring in commissions over time, we will just end up losing money because a few big losers will overshadow all the small winners. It's a zero-sum game. And again, this is the #1 question, the big question that everybody asks, but nobody answers. If options trading based on probabilities really works, and it's not a zero-sum game, how do we overcome it? Well, let's use an example to really drive home the spirit of this question, what we're getting to with this whole zero-sum game. So let's take this example, and we're going to use it throughout the course of this video, that we sell a 15-strike, 16-strike, XYZ, whatever it is, call spread. Now we take in a credit of $30 and the risk is $70. Remember that the width of the strikes is 1 and we took in a credit of 30, so our risk is 70. Our probability at that first strike, the 15 strike, of losing money is 30%. Makes sense. We take in a credit of 30 and we're taking in a probability of risk of losing of 30%. So if there's a 30% chance I lose 70 and a 70% chance, which is the inverse, that I make 30, then if I keep making this trade over and over, how do I really make money, right? Even with commissions, I make money, I lose money. 30% of the time, I make a lot. 70% of the time, I make a little. So how do we break the cycle and start making money with options trading, right? Well, to help us get to our answer, we first need to review 2 quick points. First, you have to start trading more often. Lots of data points. We talked about it before, but again, think of each of these red dots here as a single trade. What if I only made 5 trades all year long? The odds get skewed, right? So think of these red dots as single trades versus the blue dots, which are thousands and thousands of trades all year. Maybe not thousands, but hundreds of trades. So if you only make a couple trades during the year and it's just these 5 red dots, then at some point you might have a really great trade, you might have a really bad trade, but you've only made 5 trades. So how do you know if the probabilities are working themselves out over time? And even though you think you are quote unquote saving money on commissions by trading less, you're actually crippling your success right from the start. By not trading on probabilities and by focusing too much on commissions, you cripple yourself from the start, because not only do you have really bad trades that lose money consistently, but you also are paying commissions to basically give money to the market, right? The second thing is we must keep our trade size small, and we talked about this in video number 1 and 2. 2 to 5% of max risk per trade. So when you trade too large a position, you run the risk of the underlying stock making that 1 in 1 million move against you, and we call this the tail risk. It's this type of move. It's that way out of the probability range type of move. So if you trade too large and this happens, you blow up your account. But if you limit your trade size, then 1, 2, or even 3 trades that make the impossible move won't hurt you. It won't blow up your account. And again, let's use an example of how we figure out the right contract size, because we're talking about it. So let's figure out how we figure out the right contract size to manage risk using the 1516 XYZ call spread example from before. So let's say you have an account size of $10,000, which is a pretty average account size for those of you who are getting started. You may have more, you may have less. The max risk per trade, let's say, is 2% risk of your account size. So that means that 2% of that would be a max risk per spread of $70. Since you have $10,000 times 2% and the max risk per spread is $70, that means that you can trade at most 2.86 contracts. Now, obviously, we can't trade 2.86 contracts, so you can roll it up or roll it down, and maybe you roll it up to 3 contracts. So you can trade 3 spreads to keep your max risk at 2% of your account size. And remember that the odds of going bankrupt investing just 5%, so we talked about 2, but investing just 5% of your money in each trade is 1 in 3.49 billion. See, this is the thing that most traders in this industry don't get when they get started, is they think that they have a little bit of money, so they need to scale up their risk per trade. So they got $10,000, they need to trade $1,000 per trade. And that's totally the wrong way to go about it. You've got to keep your trade size small. And we've driven home these points multiple times now, and I think you get the picture, right? And if you don't, you need to keep watching these videos over and over. So again, how do we break the cycle of the zero-sum odds? It's really simple. Number 1, we talk about volatility and strategy. And number 2, we talk about waiting for profits. And again, this whole idea of and concept of risk management comes down to these 2 things: volatility and strategy, and waiting for profits. So first, we must understand where implied volatility is on a particular stock and select the right strategy. We go over this in our ultimate strategy guide here at optionalpha.com, which you'll have access to if you sign up for our free trial and membership. I put this number 1 on my list because 90+% of option traders force their strategy into a market situation. You see, they try to take a strategy and mold it into the market, instead of taking what the market gives you and creating a strategy out of that situation. So again, remember that our distribution curve becomes much taller and much more centered when volatility is low, so the stock's not going to move as much. But when the distribution curve flattens out, that's when high volatility is in the market. And that means that there's a higher likelihood that the stock makes bigger moves up and down. So if volatility is extremely high, then you shouldn't be buying options. You should be selling them. And this is the number 1 thing, again, that people misunderstand. They think that just because a stock made a really strong move in one direction, that means you can sell option premium. But that's not the case. If volatility is high, you need to be selling. If volatility is low, you need to be net buying, or at least not selling. See, most traders get this completely wrong, and you can see how they already position themselves to lose money. And it doesn't have anything to do with the direction of the market. So a lot of people will email me and say, hey, Kirk, I can't quite figure out the direction of the market, but the real underlying thing that they're missing is that they are still playing the wrong side of volatility. You have to be a net option seller when volatility is high, and you have to be a net option buyer when volatility is low. Forget the direction of the market. You get that right, and you can be wrong in your direction and still make money in this business. So number 2, we've talked about volatility, right? Number 2 is waiting for profits. Now we need to give ourselves enough time to let the probabilities work themselves out until the trade shows a profit. This means that on defined risk spreads, like the 15-16 XYZ call spread, we need to learn to keep the trade on and working until it shows a profit. Period. End of story. So exit the trade only when it makes 40 to 60% of the total possible profit. So let's again use XYZ call spread as an example. We took in a premium of $30. That means that we would start to buy back the position around $15 in price, where we've made about $15. So that would mean that we'd make 50% of the potential profit. The potential is only $30. That's all we took in as a credit. So we'll start to exit the trade when we show a nice little profit of about 50% of the premium that we could collect. See, again, this is where most people get this whole thing wrong. If you're going to really trade based on probabilities, then you have to let the probabilities work themselves out all the way to expiration. When we look at trades and it says it's got a 30% chance of being a winner, that doesn't mean it's got a 30% chance of being a winner today or tomorrow. It means sometime between now and expiration. So if you don't see a profit, you have to let that trade on and you have to wait, because that 30% chance of being a winner, 70% chance of being a winner, whatever it is between now and expiration. And you don't know if it could be the last day before expiration that trade shows a profit. So no more closing the trade early when it hits some magical percentage loss number. Take the max loss if necessary. Remember, this is why we trade small, so that we can let these probabilities work themselves out over many, many opportunities and wait for profits on each and every trade. So again, let's drive this home with just an example here on the chart. So we have SPY, and you know SPY is going to be range bound. All markets are range bound and cyclical. So if we have a trade that's centered around 164, which I've kind of highlighted here in blue, then at some point, even if we trade the bullish side of the market, we can wait for the market to come back around. Or if we trade the bullish side of the market, we can wait for the market to come back around before it shows a profit. And that's what we need to do as traders. We need to understand with options trading and probability trading that the market doesn't make our probability move the next day. We have to be patient and vigilant to let the market work itself out and let those probabilities work themselves out over many, many occurrences, over time and over months. Remember that keeping our trade size small and selecting the right strategy at the time we place the trade is all the risk management we need to do. That's it. That's all we need to do. If we've traded small, we've traded the right side of implied volatility, we've selected a strategy and kept our position small, that's everything we need to do. We can afford to let the trade ride all the way to expiration if we need to, because it's not going to blow up our account by going against us. Again, if we've done this properly and do not trade too big, then we can afford to let the trade ride out until it shows a profit, since the loss will not bankrupt us. It's been proven many times in market research that doing these two things alone are able to reverse the zero-sum game and consistently make money trading options. Wait for your probability to show itself a profit and then exit the trade. Now think about it honestly for a minute while the whole concept sets in for a bit. And again, I understand that this is probably unconventional. Most people don't talk about this, but if most people talked about this, then we'd all be making money trading options, but we're not. Most people are losing money because they're not doing this. Though it seems unconventional, like I just said, in nature, the reality is 90% of us or more of retail options lose money year after year after year. And yet we hear the same thing time and time again. Let your winners run. Cut your losers short. Blah, 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 blah. It's all a bunch of crap. People who make real money in this business consistently know that they need to do things different. So before I finish, I want to show you how you can treat full-time options trading, or how you can treat options trading as a full-time business without the big time commitment, right? You've got a job, you've got a family. I understand. I had a job, I've got a family. I'm a new father I'm a new father right now with a beautiful baby girl. So I understand the huge time commitment. But like any successful business, the key to your success trading options is to have a system in place. Not just go at this whimsically, not just try a little bit here, try a little bit there. You've got to have a system in place to be successful. So here's a quick 7-step system that you can use to scan, analyze, and make better options trades with less time. Number 1, I need you to create a small watch list of between 20 and 40 stocks that have highly liquid options activity. Okay, so this is highly liquid options activity. What does that look like? On the left side, we have SPY. Notice the volume and open interest for the November options, 30,000, 112,000 contracts. Compared to, and I just threw up a stock, NNN, which has basically no volume. One contract was traded somewhere in November. That's not a good example of a highly liquid stock with options. Number 2, 2 times per day, once in the morning and once in the afternoon, go through your watch list for any glaring opportunities to make a trade. Okay, so this doesn't mean that you have to sit in front of your computer screen. Lord knows I don't do that anymore. I do not sit in front of my screen all day looking at the market and watching every tick. Twice a day, right after the market open and right before the market closed in the afternoon, I go through my watch list and see if there's any trading opportunities. So what does this look like? It looks something like this, something that's really prominent on the chart, something that shoots up or jumps down or some big move in the stock that makes it a little bit easier to possibly choose some sort of a directional play. It doesn't look like this, where the market's just kind of trading sideways and it hasn't really moved a lot. That's not a glaring opportunity. Again, let's not pigeonhole ourselves from the beginning by just making a directional call when we really have no additional edge in the market. Number 3, once you have a stock in mind, determine first if it's currently high implied volatility or low implied volatility. Okay, and that we help for in the strategy guide that we have posted inside the membership area. Number 4, next you need to pick the market assumption about future direction. Are you bullish, bearish? Is it sideways? And again, here's where you can use some simple technical analysis. You don't have to get crazy about this. You don't have to have 72 different technical indicators up, but you just want to have some sort of underlying assumption about where it's going to go. And again, when you have stocks that are really glaring, like the one that we had up before, where it's just really high move in the market, then you can make a better assumption about where the market might move next. So again, here's where you can, again, determine where you think the market might go. Do you think it might go sideways over the next month? Do you want to make a trade on either end of the market where you're kind of trading like a long strangle or a long straddle because you just don't know where it's going to go, you just know it's going to make a big move? Whatever the case is, you want to make some sort of directional assumption. Then, once you've made that directional assumption, then you select the best strategy to fit the current market conditions. Again, don't force a strategy that doesn't fit. If you have low implied volatility, you're not going to be selling strangles. Those are high implied volatility trades. And again, this is where people get this really wrong. They take a strategy that they like to trade, like an iron condor or a butterfly or whatever the case is, and they force that strategy into each and every stock that they come across. You can't put a square peg into a round hole. It does not work. So what does this look like? This visually looks like this chart that we've talked about. You take all the factors that go into it and you find that pricing, the value, the everything, the rate of return, the timeline, where you think it's going to go. And all of that stuff factors into one strategy or two strategies that might be best for that particular situation. Number 6, you need to go to the order tab in your broker platform and then determine what probability level you want to trade. So we know what side of the market we're on. We know where implied volatility is. We know what strategy we want to trade. Now we need to determine what probability level we want to be at. Okay, so let's take that credit spread example that we had from before where we're going to sell a credit spread. In this case, we're going to go to our broker platform and looking at the January options just for now, we have a probability of being in the money or a probability of a loss of about 29% on the January 173 strike price. So if I wanted to trade a 70% chance winner, a 30% chance loser, I would go to the 173 strike. That's how I figure out exactly where my probability is and exactly where I want to place the strikes for that particular order. And number 7, you place the order being sure to take in a premium that is consistent with your target strategy. Again, we talk about this in other video tutorials, but it's worth mentioning here. You want to make sure that you're taking in a nice little profit, that you're not selling a spread at an 80% probability level, but only taking in $5. It really doesn't make it worth it, and that is where commissions start to eat up a lot of your profits. But really, that's it. 7 quick steps. So stop making it so complicated and just make the trade already. You go through this logical progression in all of your trading, let the winners ride, right? Wait until you actually find that probability of success, till it shows a profit, then exit the trade. No more managing risk, no more managing losers, no more exiting trades early. That's all it is. These quick 7 steps. So again, have a system and work through the system ruthlessly each day. If the strategy doesn't fit or the pricing is bad, move on to the next trade quickly. Don't overthink this. So questions people usually have. Do I know where current volatility is? This is what you need to understand when you're making a trade. Did I select the right strategy? Am I on the right strategy or am I trying to force it? High probability of success. Is my strike price that I've selected a high probability strike? Or am I just trading a 50-50 bet? Did I give myself enough time? Are you trading the front month contracts or the back month contracts? Typically, I like to trade all my strategies anywhere between 45 and 60 days out. I'll still trade in 30 days some contracts, but implied volatility has to be really high. And finally, is my position size small enough? Am I managing risk with my position size? And again, go back through this video if you need help with that. So I hope you guys enjoyed this, and next week I'm going to cover the exact strategies that I use to trade options regardless of market directions for income. And I'm going to go over that with some live charts, at least live at the time that I record the video, so you guys understand exactly what I look for when selecting strategies. And I'm going to work through the entire process that I just laid out for you here, only with a couple different strategies, so you won't want to miss it. I'll be going through some real positions, like I said, and some examples that you can use to see exactly how I pull all this information we learned here together. So until then, please add your feedback, comments, questions below. And oh yeah, if you found this really helpful, please share it online with other people that might need this information. Again, this is completely free, so I want you to be able to be open and share this with other people. Let's change this industry by educating everyone who's out there.